Good morning, everyone, and welcome to our Broking Breakfast seminar this morning. Today, we've chosen two topics which are high up on the FCA's regulatory radar. I will kick off the session by talking to you on wind-down planning, and in particular, the shortcomings of wind-down planning, as revealed by the FCA in their recent thematic and multi-firm reviews on the subject, and as validated by us based on what we see in practice. It then gives me great pleasure to introduce you to Charles Drew, who is making his debut on the PKF Broking Breakfast seminar circuit. Charlie is an audit director in our financial services division, specializing in insurance intermediaries and in particular client money. And we'll be talking to you today about those CASS 5 hot topics that we all enjoy discussing, but in particular those that are of particular concern to the FCA and as discussed with them in our regular bilateral discussions. And also those where you regularly push back to us when we breach you in our client money audits. Thank you. Without further ado, I will now open the session by talking on wind-down planning. Wind-down planning is not a new topic. It's been around as a regulatory concept for quite some time now, and the initial FCA guidance was issued in 2016. It became, however, a hot topic during COVID, due primarily to the regulators' concerns about firms' financial resilience. And you might all remember the array of COVID-19 surveys that were sent to the market, and which in some cases continue to be sent. The FCA reissued their wind-down planning guidance in June 2020. It was then refreshed in August 21, and more recently again in August 2023. So therefore, that proves that it's still very much on the regulator's radar. And wind-down planning is also embedded as a regulatory priority in the FCA's thinking for quite some time. If you look at the 2021 FCA business plan, financial resolution and resilience was very much an overarching priority for the FCA. And in fact, in the latest FCA business plan, the 23-24 version, the FCA said that they will continue to have a continued focus on reducing harm from a firm's failure, which really goes to the very heart of what wind-down planning is all about. To understand wind-down planning, we also need to have a look at its interaction with Threshold Condition 2.4, TC 2.4. As I said, originally, the initial guidance was provided in 2016. And if any of you are looking at preparing a wind-down plan for the very first time, you need to have a look at appendices 1 to 12 of the wind-down planning guidance. And they have what they call a quick reference guide in there. And that's really a really good framework to help solo regulated firms put wind-down planning theory into practice. It provides a blueprint of what you really need to sort of know and what you need to encompass in your wind-down plan. Firms are reminded of the need to actually comply with TC 2.4 throughout the period of wind-down. And effectively, TC 2.4 is all about threshold conditions and ensuring that firms have adequate financial and non-financial resources, not just during the period when they're undertaking regulated activities, but also during their period of wind down. And in fact, the FCA requires you to have adequate resources at two levels. Firstly, at financial level, and that's really all about having sufficient capital and liquidity during the wind down process to ensure that you're going to be able to undertake your wind down in an orderly manner without running out of capital or liquidity, and in particular, without having and causing an adverse impact on your stakeholders. And those stakeholders are your clients, your counterparties generally, and in fact, the market at large. Additionally, you need to have adequate non-financial resources. By non-financial resources, I mean things such as adequate sort of human resources in place, adequate IT infrastructure, adequate access to professional advice to ensure that the runoff process progresses as planned. And here you've got to think about things differently, really, because in a wind down situation, this isn't business as usual. So you have to really think about the behavioral sort of characteristics of the service providers that you're going to be calling on. So for example, you might want to ensure that you have paid staff retention bonuses to retain them to stay on and assist you with the wind down process. Similarly, IT infrastructure providers, they're going to want to make sure that they're going to be paid. So you might need to negotiate upfront payment for their services, similarly with professional advice. And finally, wind down planning is really ingrained also in the FCA's principles for business. So principle 4 in particular basically states that the FCA requires all firms to comply with the general FCA rules and threshold conditions, both during its time as a regulated entity undertaking regulated activity, but also during the period of wind down to enable an orderly wind down. So in terms of what is a wind down plan, a wind down plan is a formal document, and it aims to enable a firm to cease its regulated activities and achieve the end game, which is really the cancellation of its regulatory permissions, in a way that it won't cause any adverse impact or harm on clients, counterparties, and wider markets. You will hear me say this a few times, and I make apologies for that, but that is the real crux of what a wind down plan is all about, ensuring that you're planning your exit from the business in such a way that you are not harming your clients, your counterparties, and the wider market generally. A popular misnomer is that it doesn't apply to every firm. That's completely wrong. A wind down plan is compulsory and applies to all regulated firms, not just those firms that are in financial distress. It would also apply to firms who are perfectly healthy and are continuing to carry on in business, but are seeking a particular strategic exit from a particular market. There's no set template or pro forma required. The wind down plan needs to be tailored to the firm's own circumstances. And again, if you're doing this for the first time, I would really strongly refer you to the FCA's quick reference guide in the 2016 guidance, as this sets a really good sort of, blueprint of how the wind down plan needs to be sort of put together. It applies to all FCA solo regulated firms authorized under a Part 4A permission. That effectively means that if you are, for example, dual authorized, and there are some groups where you will have effectively some entities which are authorized by the PRA or other regulators, and others which are under the FCA. In such a situation, the PRA's regulations would trump those of the FCA. And it doesn't apply to firms which are already in some sort of insolvency arrangement. So it doesn't apply to firms that might be in administration, in liquidation, etc., because under these sort of scenarios, the liquidators will already have agreed their own sort of repayment and effectively wind down plan with their own creditors. Although one might hope that when they're dealing with an FCA regulated firm, they will also take account of the FCA's rules and the threshold conditions in effectively formulating their own repayment plans. A wind down plan needs to be a living document. It's not just a document that's done once upon a time and then effectively put away in a drawer, not looked at again, and you tick the box and say you've done it. It needs to be refreshed periodically, particularly where there have been significant changes in the business model. In such circumstances, you would have to relook at the operational characteristics of your wind down and be able to model the effect of any changes that have taken place in your business. Very important to say that the wind down plan has to be credible. It has to be capable of being operated. It has to be up to date, comprehensive, and operable. So therefore, there needs to be a logistical conclusion to how that wind down plan is going to be executed. You've got to know the steps that you've got to undertake, and they've got to be realistic. And in practice, what we see is that a wind down plan really includes two main areas. We'll look in a moment at the various sections that would be encompassed in a wind down plan, but generally they come under two main sort of guises. Firstly, the financial side. That's the financial projections, the cash flow modeling, the detailed assumptions behind that modeling. And really, the idea here is to be able to identify the TC 2.4 buffer that you're going to require to have in place to be able to have an orderly wind down. And this needs to be accompanied by a detailed narrative plan, which actually tells the story in detail of how you are going to, from a logistical point of view, achieve the wind down. It's also important to note that this is not just a document prepared by the finance department and then put away, as I said earlier. This is a formal document. It's a real sort of integral part of the firm's governance process, and therefore it needs the buy-in of the board of directors. And as I said before as well, the end game is the cancellation of the firm's Part 4A permissions. The FCA is not going to cancel your regulatory permissions and let you off the hook until they're satisfied that they've seen your wind down plan and that you're going to be able to exit that market in an orderly manner without causing any harm to any of your counterparties. I want to look at now what constitutes a good business plan. As I said at the beginning of my presentation, there's no right or wrong way of preparing a wind down plan. It just needs to be tailored to your own circumstances, and it needs to achieve the end game of demonstrating that you can exit the market in an orderly manner, again, the popular phrase, without causing harm to customers, the wider market, or other stakeholders. But I think financial commentators generally agree that a wind down plan has certain key sections that you would expect to see. And in fact, these dovetail quite nicely with the guidance originally provided by the FCA in 2016. The first part is that you'd expect to see some section on business background generally. So this would be an overview of the entity's business areas, the business model, everything really to provide a little bit of context on how the firm is put together, what it consists of, and therefore what's going to be wound down. There needs to be also some commentary on the risk management framework, an overview of the entity's risk management framework, covering the processes for monitoring risk, and in particular, the relevant wind down triggers which are inherent in wind down and the risk management thresholds. And I'll come on to the concept of wind down triggers in a moment, because that's really central to wind down planning. And also there needs to be some sort of explanation of the governance structure, an explanation of who owns that wind down plan within the organization, what mechanisms are in place to actually invoke the plan, and details really of the governance arrangements surrounding the wind down process. So coming on to wind down triggers, as I mentioned earlier, this is a really integral part of the wind down plan. Generally, wind down plans are prepared under a stress scenario. They don't need to be, because you can be trading perfectly well and just wanting to exit the market. But inevitably, the FCA expects you to model a situation based on a stress scenario. And therefore, it expects you to basically evaluate the various potential wind down triggers that could apply to you, and effectively to explain in your document why you are choosing the final wind down trigger that has been selected. I mean, wind down triggers take many forms. It could be there's a pandemic and therefore we all lose our business. It could be that a firm has suffered a very large regulatory fine by the FCA, and as a result of that, you have lost reputation. Clients don't want to deal with you, and as a result, you lose business. You're no longer viable. You'll need to go into wind down. It could be a big errors and omissions claim, which effectively blows your cover. You can no longer afford to stay in business, and you have to go into wind down. So there's lots of different triggers, and the FCA actually expects you to model these different triggers, although at the end of the day, you will choose one trigger, which will form the basis of the plan, and it expects you to understand the operational differences and implications arising from each trigger, so that if a different trigger to the one that you've modeled actually happens in real life, you will understand those operational differences and how to model the wind down planning. A wind down plan needs to also include an impact assessment, and this is the assessment of the potential harms that could befall those stakeholder groups. As I've said many times, a wind down plan is all about ensuring that you can exit the market without causing harm to your stakeholder groups. So you need to evaluate what those harms could be to be able to put in place the mitigation to minimize the impact from those harms. And there needs to be an operational analysis. And this is where we have the narrative explanation of the step-by-step key activities that you would expect to see in a wind down situation across all of the business areas. And in real life, when we've done wind down planning, what we've done is that we've looked at and spoken to and normally had workshops with the different areas of the business just to understand the peculiarities of how they operate, so that we're able to basically model in a more granular basis how the different aspects of the business operate, so that we can wind them down and plan the wind down plan correctly. In addition, we need to have our resource assessment, and this is effectively the evaluation and assessment of the financial and non-financial resources required to execute the wind down plan. And this follows the impact assessment and the operational analysis that we saw earlier. This is where we combine the narrative plan with the detailed cash flow and profit projection analysis and the underlying assumptions, and how we demonstrate how that TC 2.4 buffer is maintained at all times. There has to also be a communication plan embedded in the wind down plan. It's very important that you communicate your wind down strategy with your stakeholder groups as clearly as possible. I mean, when a company goes into wind down, inevitably there's a smell that it's in financial trouble. Stakeholders might want to run for the woods. I mean, they don't want to be associated with you. They might be concerned about your ability to pay them. Employees might quickly give in their notices. So you need to think about how you're going to attract these various stakeholders. Employees, for example, you might think about giving them a retention bonus. IT infrastructure providers, you might need to pay them up front. Professional advisors are the same. So you need to communicate with these. You need to have a communication plan that deals with each of the stakeholders to ensure that you keep them on side during the wind down process. And finally, you might be able to undertake your wind down on a group basis if you are a group and the entire group needs to wind down. So you have to actually look at the interdependencies that exist in a group situation and how any groups or any risks arising from this group interdependency have been mitigated into the wind down plan. I'm going to be talking about this a little bit more in a moment, because that was one of the areas that the FCA themselves identified as a key weakness in wind down planning. So that's really, in a nutshell, what constitutes a good wind down plan. Those are the key areas that we'd expect to see. And we will now talk about the FCA's own findings with wind down planning and after the various studies that they've done. So the FCA conducted a thematic review on wind down planning back in January 2022. And they then supplemented that with a more general multi-firm review that was carried out in September 2022, where they looked at a whole variety of entities across the entire financial services market. But that included 10 GI, general insurance intermediaries. And these were mainly the larger London market commercial GI brokers. They found that where wind down plans existed, and in many cases the firms that they investigated, there were no wind down plans. The wind down plans were at a very early stage of maturity with substantial gaps, and that they needed significant work to meet the FCA's minimum standards. In particular, they needed significant work to make those wind down plans credible and operable. And although they found some examples of good practice, generally most wind down plans showed considerable room for improvement. So generally the FCA weren't particularly happy with their findings. There were three main areas that the FCA found were weak in wind down planning. The first is the whole issue of liquidity. They generally found that firms were good at monitoring and budgeting their capital needs. And this is because most of you as regulated firms need to effectively sort of look at your capital requirements on a periodic basis as part of your RMAR reporting to the FCA. So this is something you're good at and you do anyway. But firms were less good at monitoring liquidity needs in a wind down context. In particular, the FCA found that firms didn't really properly demonstrate how the calculated TC 2.4 buffer was going to be ring-fenced. And normally what we find in practice in good firms is that they have calculated what their TC 2.4 buffer needs to be, This is the amount of money that they need to go put aside for wind down purposes. And normally what they find is that this is ring fenced in a designated account. They've done their calculations. They found that if they go into wind down, they're going to have to spend about 5 million quid in winding down the business in terms of payments to suppliers, retention bonuses to staff, etc., etc. In such a situation, you need to ring fence that money. So you will effectively put that money in a separate designated account. Also, what we're seeing in the market at the moment is that in group situations, you can actually use a drawdown facility for wind down purposes. So, we find a lot of our more complicated groups have things such as revolving credit facilities or general sort of, debt drawdown funds. And in such a situation, what you might want to do is you might want to ring fence or earmark part of that drawdown fund and have that available for drawdown in case you need to go into a wind down plan. That works quite well in a group situation because, in a group situation, your main cash inflows are going to be the sale of your subsidiaries, the sale of your books of business, sales of goodwill, etc., etc. And you can therefore allocate some funds comfortably in the knowledge that you will have considerable inflows coming in to then pay the drawdown facility or the general debt that's accrued as a result of this. The FCA found that there were cash flow timing mismatches between the cash inflows and the cash outflows in wind down planning. So if you think about it, when you go into wind down, you're going to start incurring costs from day one. You're going to have to start paying your staff who you've retained to do the wind down exercise. You're going to have to start paying your suppliers. You're going to probably have to have paid up front in a lot of cases, but your inflows rather, the monies that you've got available to you to effectively utilize, you might not get those until a couple of months into the wind down period. For example, if you're planning on selling your assets, selling your subsidiaries, there's going to be a bit of a lag between the moment you go into wind down and when that money actually comes in. So the FCA found that firms weren't good at effectively ensuring that they have sufficient liquidity to actually handle the net cash impact during the wind down period and maintaining a positive cash flow throughout. And one of the secrets of this is really to ensure that you have a healthy cash balance at the start of the wind down period to avoid actually entering into the wind down process in a state of financial distress. And this goes back again to the whole issue of ensuring that you have properly planned, you've calculated your TC 2.4 buffer, you have these funds in a designated account so you can access them as soon as you go into wind down. The FCA also found that firms need greater granularity of detail in their cash flow modeling. When they looked and they reviewed the cash flow projections, they found that some of the assumptions were oversimplistic and therefore they didn't lend themselves to good, credible, operable wind down plans. And they also found that firms hadn't really sort of looked at the behavioral assumptions surrounding the wind down period and the wind down process. So for example, as I said earlier, this isn't a business as usual type of scenario. It's very much a wind down scenario. So you need to think about how you're going to treat your staff. You're going to pay them retention bonuses. Your creditors might become a lot more demanding. They might demand upfront payments. Your debtors may become a lot more cautious. If they can get away with paying you because they think you're not going to be around in 3 or 4 months, they might do so. So you really need to enhance your credit control procedures. Your IT suppliers will require upfront payments. So you've got to think about the behavioral sort of assumptions around wind down plan and factor those into your cash flow projections. The second area that the FCA found was weak in their review of wind down plans was this whole issue of intra-group dependencies. The FCA permits wind down planning to happen on a group basis, provided that there's also an entity view available for each individual FCA regulated entity. But the FCA effectively saw that there was inadequate consideration of the impact of group membership on the UK regulated firms' ability to wind down. They acknowledged that being part of a group can be very much a positive, but they also found that firms failed to consider the potential stress that can be caused by this interconnectivity. And interconnectivity arises, for example, where the operations of the UK regulated firm that's being wound down involves financial or non-financial resources from other legal entities in the group. So, for example, there might be a group HR function. The IT system might be run by a service company somewhere else in the group. And the FCA actually believes that firms with significant intra-group dependency and this connectivity could result in becoming a point of vulnerability for the UK regulated entity, because effectively the decision making is not with the regulated entity that's being wound down, it's being held somewhere else. So that can make the firm that's being wound down potentially vulnerable, and the wind down planning can be potentially vulnerable. And the FCA found that these intergroup dependencies exist in various ways. It can be financial interconnectedness as a result of potentially intergroup funding. It can be operational interconnectedness, as I've already explained, as a result potentially by having maybe IT in a different part of the group, or as is often the case, with the group having the key relationship with the suppliers rather than the regulated entity, which effectively means that the regulated entity doesn't have that much control in what it can negotiate with its suppliers. Or it can take the form of contingent financial support, such as in situations where there's parental guarantees or group financing facilities, again, where that control over the finances is not directly with the regulated entity that's being wound down. And generally, the FCA found that there was a lack of assessment of the interconnectedness that existed in wind down plans, the impact of this on the regulated entity's capability to wind down, and the mitigating actions that it could take to actually minimize this risk of intra-group dependency. The final sort of weakness that they found was around the issue of wind down triggers. And the FCA found that there was normally a failure to identify a main trigger and act on that well thought out trigger as being a credible initiation point for wind down planning. It found that in some cases, firms had not identified the wind down trigger at all, and they'd just gone down willy-nilly and prepared a wind down plan without really thinking about what was the trigger that initiated that wind down. And that really means that the mapping of your cash flows are all over the place, really, and they can't be specific to the main course of the wind down. The FCA found that firms failed to consider the range of potential triggers that are available, and therefore, through lack of planning, a firm would be ill prepared if the wind down actually arose as a result of a trigger that wasn't the trigger they'd mapped. So you really need to understand what are the triggers that could affect us, and you need to choose one, but at the same time, you need to map your cash flows, your inflows and outflows arising from other potential triggers, just to see those operational differences that could arise from other sort of wind down triggers. The regulator also failed to see any link between the triggers that were being chosen and what the firms actually deemed to be risks as included in their risk registers. And they also saw that there was poor correlation between the wind down trigger and the actual financial resources that were being modeled and were required to wind down. So that's really a nutshell of the various findings that the FCA and weaknesses that the FCA found in their various reviews. And it's clear to say that they weren't happy with what they saw. There's substantial work to be done. Now, having said all that, I want to now just take you through what we as a firm see in practice when we review wind down plans. And we're now asking for wind down plans as part of our flat money audits. I'm asking for wind down plans generally when I do a statutory audit, just to make sure that this is all in place, looking at this from the context of, compliance with laws and regulations, etc. So what we see in practice is that not all firms have a wind down plan, and many firms still believe that it doesn't apply to them. That's completely wrong. As I said earlier, it applies to all regulated firms. Many firms that have prepared wind down plans are really good at doing all the financial stuff, all the financial projections, the cash flow modeling, but they lack the narrative plan that goes with them to tell the story of how operationally the wind down plan will take place, which is just as important as the financial aspects. Firms haven't been paying also sufficient attention to the wind down trigger. As I said earlier, and as identified by the FCA, many firms apply this cannot possibly apply to us type of attitude. They look at the potential sort of wind down scenarios and they say, that can't apply to us, that can't apply to us, that can't apply to us. So really they have nothing that they think is applicable to them, so they don't choose a wind down trigger. And that's the worst way that you can potentially approach a wind down planning exercise. Firms also mistake wind down plans for business continuity plans. That's complete nonsense. A business continuity plan is a complete opposite to a wind down plan. A business continuity plan is about demonstrating how you're going to be able to continue in business. A wind down plan is all about demonstrating how you're going to exit from the business. So, you know, when I go to a firm and say, can you show me your wind down plan? And they show me their business continuity plan, that really proves that they don't really understand the concept. Many firms have their finance department prepare their wind down plans as a tick box exercise, really, with insufficient buy-in from senior management. If you ask the directors to show you their wind down plans, they'll refer you to the finance department, and that's not the right way of doing it. The directors need to be aware, and they need to have basically sort of given their okay to the wind down plan. They need to be aware of what the wind down plan consists of and be able to, you know, discuss this with the FCA if they're asked. We've also seen a lot of examples of poor financial modeling with very oversimplistic models, which aren't really conducive to having the wind down plan as an operable, realistic and credible model as required by the FCA. And in general, I think the conclusion is that most of the wind down plans that we see are not fit for purpose. So what's next from the FCA on wind down planning? It's clear that they're not happy. We've validated that in terms of our review of wind down plans. And the FCA actually said after their thematic review and multi-firm review that they will continue engaging with the GI market on wind down planning until 2025. I haven't seen any direct evidence of that just yet. I think they've had other things that they've been focusing on, but I wouldn't be surprised if either later this year or next year they do another big sweep of the market and ask the firms to present purely on a random basis their wind down plans, so they can have another look and see whether the whole concept of wind down planning has improved. And I think that the FCA are going to likely deviate from the current softly approach that they've got. At the moment, what they've said and what they said after their various reviews, they're encouraging firms to consider their own wind down planning arrangements vis-a-vis the FCA's findings and try and improve their own plans. I think that softly approach is going to go away, and we're going to see a much harder and stricter enforcement-based approach. And it's very clear to me that the FCA are not going to go away on this. They still have great emphasis on financial resilience. It's clear to them that this is still an area of weakness, and all I think that's going to happen is that wind down planning is going to move higher and higher up the regulatory radar. And it's also likely that there are going to be consequences, and we've seen this already in the wider financial services markets. So, for example, where there is poor wind down planning in the investment management space, we're seeing that in some cases where the wind down plans aren't to the FCA satisfaction, they're imposing additional capital requirements on firms to ensure that if they do go into wind down, they have sufficient capital in place. That means a hit to the pocket. That means ensuring that you've got sufficient, capital requirements put in place. There might need to be a capital injection from shareholders, but clearly, if your wind down planning isn't up to scratch, they might well ask for more money. Or additionally, what we're seeing as well with the electronic money institutions that we act for is that they need to actually submit a wind down plan as part of their initial authorization process. And what we're seeing is that the FCA deems these to be inadequate. They're just not giving you permission. They're delaying the authorization process. We're also seeing that other regulators are taking note, which really indicates that this is becoming an issue of much greater importance in the overall market. For example, the PRA has really delved in on wind down planning for the non-systemic banks. And I'm also seeing mention of this with EU insurance regulators. For example, I know that BaFin have been doing their own review of German insurers and insurance intermediaries wind down plans. So effectively, my final takeaway from this is to ask whether you're prepared. I know for a fact that most of my clients have considered wind down planning. There are still some that haven't prepared a wind down plan. You know who you are. I'm not going to embarrass you, but you know the FCA could come calling, so ensure you are prepared. So of course, PKF can help you with your wind down planning. Myself, John Needham, Ian Cowan, also Satya, who joined us recently from PwC. We've all got experience of assisting clients with wind down plans, and we'd be happy to help you with any requirements you may have. So without further ado, I'll hand you over to Charles Drew, who's going to talk about CASS 5.
Thanks, Paul. Today, I'd like to take you through our CASS 5 hot topics for 2024. So that is the key areas that we've identified from our audit work in 2023, and also the topics where the FCA have very recently raised concern. Hopefully, this will help you avoid pitfalls for your upcoming CASS audits in 2024. So every 6 months, we hold meetings with the FCA to discuss key issues, and internally we discuss any contentious areas we identify from our audit work. From those discussions, the areas we'd like to cover today are client money calculations, being our most common breach, client by client reconciliations, and how we might be able to use these in a smarter way, the CASS 5 risk and controls matrix, something that we get a lot of pushback on, and so we wanted to highlight the FCA's view. Credit write-backs as probably the number one area that we discuss with the regulator, and something that they've shown increasing concern around. And lastly, consolidated transfers of books of business, and in particular, transfers of client money from a statutory trust to a non-statutory trust environment. So first, we'd like to talk about client money calculations. Most of our clients are very good at this, but it is still something where we see breaches relating to the client money calculation, and that's consistent with the FCA and their experience. The issues we tend to see relate to the completeness of a client money calculation. So here, best practice, as it's always been, is to tick in insurance-related balances from your broking system trial balance. The other issues we see here really tend to be resulting from not having a clear understanding of system-generated reports, and there being too much reliance on external data such as bank statements. The other thing we continue to see is mid-month transfers, and in particular where they're not supported by a client money calculation. These, in the FCA's view, highlight a need for cash, and actually a shortage for cash, and it reads into the narrative of their review of firms nearing failure. These would be informed by a realised or a brokerage report, and actually we should make clear it's completely permitted to withdraw your surplus as and when you'd like, but we wanted to make clear this has to be following a properly conducted client money calculation. Next, we wanted to talk about client by client reconciliations, and in particular relating to funding. So there's still a continued focus on the insolvency mindset, and this is still a breach that we continue to see. This tends to be, again, relating to not having a clear understanding of system-generated reports from the respective broking system. This really is a critical document in ensuring money can be redistributed effectively. But also it demonstrates that robust systems and controls are in place, and it can be used as a tool for monitoring funded balances. So the FCA has an increased interest in bad debt provisioning, and in particular funded bad debt. And in this area, they really want to be able to see robust evidence for the recoverability of aged balances, and to support any unprovided balances. Lastly, we still see firms operating a statutory trust account, and in our experience, it's really difficult to operate a statutory trust account and not fund, where you have technical funding and offsetting. So here we see this as an opportunity to use your client by client reconciliation to identify those funded balances and correct them where necessary. The next area we wanted to discuss was the risk and controls matrix. So this is something we do tend to get a lot of pushback on. Firms are required to have in place a CASS risk mapping document. And what is this? It's essentially a record of the controls in place to mitigate the risk of non-compliance with each CASS requirement. So the FCA has been consistent on their view that an up-to-date CASS risk mapping document is required, and it's key for maintaining the client money environment under Principle 10 and maintaining adequate protection for client assets. If you don't have this in place, it is considered a breach. We still receive challenge on this point for exactly that reason, that it's not included explicitly within the CASS 5 handbook, but we wanted to reiterate this is the regulator's view, despite it not being included within the CASS 5 rules. The expectation is also that this document would be updated and current, and therefore reviewed on at least an annual basis. So recording this as a breach is the approach that we've taken. And if it's something that you don't currently have in place, we do have some guidance available on our website to assist you in preparing this document. Next, we want to discuss credit write-backs. And as I mentioned, this is the #1 topic that we discuss with the FCA, and it's really an area of concern for them. They're generally seeing more incidents of credit write-backs from client money where monies can't be paid to the counterparty and it's not due and payable to the firm. And this is where they are seeing credit write-backs, they are seeing this as an indicator of weak financial resilience by the FCA. The concern has been raised consistently for the last few years, and in particular following COVID, and it continues to be a high priority issue. The concern here is that firms might be resorting to using credit write-backs to prop themselves up under these market pressures, as I said, for example, with COVID or the cost of living crisis. The highest concern is for balances that have been created recently, so anything within the last 5 years, as they see this is not a long enough time having passed to go ahead with the credit write-back. From our most recent meeting, they made clear also that they consider credit write-backs to be a breach of fiduciary duty, where the expectation is that they would only be required due to the lack of robust systems and controls for the accounting and handling of client money. And they also review credit write-backs as a potential breach of trust law because the firm is profiting from the operation of a trust account. So from our experience, we're seeing differing legal opinions on exactly that point, whether it really is a breach of trust law. And so we expect more clarity from the FCA on this soon. For now, we recommend seeking a legal opinion to support future credit write-backs. So with that in mind, what is the best approach? It's acknowledged that firms continue to use credit write-backs to clear down legacy balances, but this should only occur where balances are due and payable to the firm under the CASS 5 rules, or where the firms have obtained explicit consent from the entities to write off the balances. So the FCA wants firms to be proactive here in obtaining direct written confirmation that no funds are owed to a counterparty before effecting their credit write-back, rather than simply proceeding having not heard back. The expectation is also now that the amount written back would be donated to charity as a discharge of the firm's fiduciary duty. This is consistent with the approach of CASS 7, and that's been in place for a number of years, following that view that the firm should not be profiting from the operation of the trust account in this way. When carrying out a credit write-back, there's also an expectation that this should be minuted within board or appropriate CASS committee minutes. And so here the emphasis is really on the justification through a clear credit write-back policy, and also considering the FCA's view on those legal implications of trust law. Next, I wanted to just discuss consolidators. Here, the FCA welcomes consolidators, and this is we often discuss the role of consolidators for CASS 5, where we continue to see M&A activity in 2023 and continuing into 2024. So it remains a hot topic. The FCA welcomes consolidators as an effective way to raise client money standards. Most consolidators moving newly acquired firms into more tried and tested embedded group systems and procedures. And they see that this is a way of reducing the risk and quantity of smaller non-compliant brokers in the market. For us, we continue to see clean CASS opinions for newly acquired entities into groups and identify a significant number of breaches in the first year we order them. For context, we probably give maybe 1 or 2 clean opinions from roughly 130 CASS audit opinions in a year, and so it's worth noting that that clean opinion is very rare, as it's very difficult to comply with the rules 100%. So there's a benefit of fewer regulated firms, but there's also a risk in making sure then that client money is transferred correctly. And especially here where there's that move from statutory trust to non-statutory trust accounts, as it's higher risk for clients due to the possibility of funding. This topic is similar to credit write-backs, where it's seen as another area that the regulator views. There's perhaps the importance of trust status is not being, it is being misunderstood. So in terms of transferring client money, we sometimes see firms making transfers of client money following an acquisition from the acquired entity into their own trust environment. We know groups want to complete this process as quickly as possible to reduce their administrative regulatory burden, but as a result, we know that then it's a risk that client money is transferred incorrectly. The FCA want to ensure here that clients receive appropriate communication relating to how their money is held. So they expect 85% consent from clients before applying for a waiver of the residual amount before transferring money between environments. And we know this is difficult to achieve. But if it's not carried out before a transfer between environments is made, it is a breach of trust law as a transfer of client money from trust outside of the CASS 5 rules. So the simplest solution now we're seeing, and this is supported by the FCA, is to be including terms within your consumer TOBA that to explain that money may be moved in the event of a future group reorganization or something like that. If this is communicated to clients in this way, though, they have reiterated that they would expect this to be clear and not hidden in the small print. So here, best practice is still, where there is any doubt to the ability of gaining client consent, is to move renewals into the new environment and to run off the balances before closing the client money account and cancelling the firm's permissions. Lastly, on consolidators and moving from a statutory trust to a non-statutory trust, the same 85% consent is required before applying for that waiver to move money from a statutory trust to a non-statutory trust account. Again, because of the increased risk to clients. The firm also needs to demonstrate it meets the requirements of CASS 5.4 for non-statutory client money trusts, and that includes appropriate systems and controls, appointment of a client money manager, your assigned trustee, adequate resources, and those procedures in place to manage credit risk arising from the operation of the non-statutory trust. As a reminder, an auditor's NST confirmation letter is required to confirm that those adequate systems and controls are in place. And lastly, where the NST letter can't be obtained, the FCA's view that this is a serious matter, and they expect all of the relevant breaches as the reason why a letter couldn't be obtained to be rectified as soon as possible before asking an auditor to renew the NST letter. And actually, if that's something that can't be completed, they would now be requesting firms to move back to a statutory trust to reduce that risk for consumers. So on to our hot topic takeaways, just to recap on client money calculations and that client by client reconciliation, making sure that you understand how those system generated reports are used and ensuring the completeness of the balances included. On our risk and controls matrix, making sure you have one in place to demonstrate the robust systems and controls, but also to review this annually and make sure it's current. For credit write-backs, as that top issue, considering deemed or actual consent before effecting a credit write-back, and obtaining appropriate legal advice to establish that the credit write-back doesn't breach trust law. And lastly, on those consolidations and change in environment, considering the communication to consumers and their consent before any transfer, and keeping again in mind the implications for trust law compliance. So with that, I'll hand back to Paul to close.
Thank you very much, Charlie. Well, that concludes the formal elements of our presentation. I hope you found our webinar today useful. We've covered two very important topics, which are clearly very high up on the FCA's regulatory radar. Just to repeat that we will be happy to help you in delving through any of these issues. Very happy to help you with any wind down planning issues that you might have, or even if you're preparing your wind down plans for the first time, and also to help you with any CASS issues that you might have at the moment that you need to discuss. Thank you all very much for listening. Thank you. Bye-bye.